Back in 2007, Peter Ciganik joined GTIS Partners, which was then a two-year-old real estate investment management firm. This year, as GTIS marks its 20th anniversary, it manages 4.7 billion in assets, and Ciganik himself handles a wide range of responsibilities as the company's head of capital markets. In college, Peter pursued his lifelong enthusiasm for architecture and art history. Maybe those topics seem a little removed from his executive duties today, but they still contribute to his perspective. As he puts it, we spend a lot of time thinking about the right designs, the right location, and the right product. Hello, and welcome back to Investment Matters. I'm Paul Rosta. In this episode, you'll get an insider's view of the factors shaping the real estate capital markets, on the prospects for the industrial sector, and on the region that the company finds especially attractive. And you'll hear about a favorite pastime that literally keeps Peter Ciganik on the go. Take a listen. Peter Ciganik, welcome to Investment Matters. It's really nice to have you with us today.
Hi, Paul. Very nice to be here. Thanks for having me.
Absolutely. Well, I wanted to get started by talking a little bit about the capital markets. As you know, we're in a transitional period here as we speak in early 2025. A lot of moving parts out there right now, as everybody knows. But even though that makes it difficult to predict what's going to happen this year, what are the kinds of indicators that you will be watching for, whether it's what the Fed does, what certain categories of lenders are doing? What's on your radar this year as far as things that are going to influence the real estate capital markets?
Well, no shortage of surprises, right? Both in the capital markets, the larger political and economic landscape. And I think that is really affecting what the prospective thoughts are on capital markets as well. We'll all be watching things like inflation figures and what the Fed does about that. And we'll be watching policy decisions that are going to affect not just capital markets, but the economy more broadly, things like tariffs and questions about labor. But for us, obviously, real estate being a leveraged asset class, interest rates are very important, and so is the availability of credit. And that's been challenging over the last few years with the banking closures. I guess it's now almost 2 years ago. The whole sector went into a bit of a tailspin, and it's still quite expensive and quite challenging to borrow. So we'll be looking for signs of easing. And as the Fed cuts rates, hopefully a couple more times this year, we'll see some reprieve from that. It's interesting to note, though, what's happened to long-term rates, even as the Fed has cut the short-term ones. It's a bit like pushing on a string. The Fed effectively just controls the short-term overnight rate, as we all know. But even though they cut that by 100 basis points, literally, I just looked at the graph. Since that day when they started cutting, long-term rates are up 100 basis points. That is very, very unusual, signaling in the market something about the long-term view of perhaps U.S. credit as a borrower, perhaps just sentiment and reflection of expectations. Maybe people were expecting more cuts and now there's been a disappointment. But long-term rate going up by 100 basis points when short-term rates are down by 100, a little bit of an unusual situation. And it impacts everything from commercial real estate, borrowing, all the way down to mortgages for home buyers. So we are definitely watching that and hoping for some improvement.
Yeah, I mean, is that a bit of a disconnect? A kind of not the historical trend. That's kind of what it sounds like.
This has really not happened before. And, markets never kind of act in the same way because there are too many variables that change. But one of the more stable relationships is when the Fed starts cutting rates, the long-term tail should also start coming down unless there is some unusual reasons why the short-term and the long-term borrowing is working off of different fundamentals. And I suspect there are questions about our ability to defeat the persistent inflation. The market is probably looking at some longer term effects of tariffs that are inevitably going to push the inflation rate up. We don't know by how much because we don't even know what the tariffs might be. And then labor costs, that's another question on people's mind. If there is going to be a reduction in the amount of active labor, then we will likely see some inflationary push there as well.
The GTIS invests in a diversified portfolio. And on the commercial side, for instance, you have a significant industrial footprint in the US. Um, First, what's your overall view of the prospects for the industrial real estate sector this year? What's going to be driving the market? Anything different that you'll be on the lookout for this year compared to 2024? And along the way, I'd also love to hear your thoughts on the financing implications for the industrial sector, for the capital markets outlook, as well as investment itself.
Well, that same volatility and uncertainties in the market clearly impact all property sectors. But interestingly, industrial has dealt with that really quite remarkably. There's been no shortage of headwinds, whether it's high interest rates, inflation, labor disputes, and so on. But the US industrial market actually remained quite resilient in 2024. There was an absorption of about 135 million square feet. And the second half was stronger than the first half. Compared to 2023, that was a bit off, but still a pretty strong year. And we think 2025 should actually be better as some of the markets are coming back. For instance, Phoenix, Savannah, Salt Lake City had a net absorption figure that has increased by about 35%. So it seems like we're over the hump, so to say. And we could see as much as 200 million square feet absorbed in 2025 as leasing picks up. Vacancy is still really quite low at about 6%. It's not unusual for the industrial market to have a 10% vacancy, and that's resulting in continuing rent growth. Perhaps a little bit surprising given the amount of supply that that market has seen. Developers have brought in quite a lot of new projects in response to the really strong demand during the pandemic. And as that supply works itself through, there's been a bit of an increase in vacancy, but it still has resulted in positive rent growth, which is quite remarkable. So if we can get over this supply hump, as we call it, which should crest in 2025, we're actually probably looking at a pretty interesting market in the next couple of years. And we are looking actively at opportunities to both acquire as well as develop new projects in certain markets that have the strongest fundamentals.
Well, as an investor and developer, um, what categories of industrial assets look most attractive right now, whether it's new builds, value add opportunities, some combination of the two, last mile assets, major seaports. You mentioned Savannah, for example. What's kind of on your radar in that respect?
Yeah, let's take those in turn and separate into markets and property types and perhaps just kind of go through that one by one because they have different drivers. So we are mostly focused on mid-sized properties between about 200 to 500,000 square feet. These assets look like big boxes, but they're not the million square foot bombers that Amazon or one of the large distribution platforms typically use. We mostly engage with smaller tenants. Our properties are often multi-tenant, meaning two or three different parts to a project that have demising walls, and we have several tenants in one property. We work with both distribution and logistics tenants as well as light manufacturing. And the drivers behind that are threefold. The shifts in trade that are happening are really supporting the Southeast compared to what historically was the distribution base in California, particularly the Inland Empire and around Chicago. A lot has shifted in terms of where the trade comes from. The port of Savannah, for instance, became the third largest port in the country in terms of container tonnage during the pandemic, as the ports of LA and Long Beach lost share due to strikes. In fact, Savannah overtook Oakland, San Francisco, and Seattle and became the third largest port, as I mentioned, right after New York and LA. That's because a third of the country now lives in that location, about 100 million people just around Florida, Georgia, and the Carolinas, but they only have about 10% of distribution space. It's the reverse in places like Chicago or the Rust Belt, as people have come to call it, where you have about 10% of the population, but 30% of industrial space is there because it used to be the big rail hubs. So we see opportunities geographically, particularly in these Sunbelt markets in the Southeast. The corridor between Charlotte and Atlanta has been a very strong place. And now the second driver is happening there as well, which is investment in manufacturing and general infrastructure investments. A lot of investment in electric vehicle battery manufacturing, a lot of investment in chips, basically coming from the CHIPS Act. So the whole place is now known as the Battery Belt down around Charlotte and Atlanta. And that's driving employment in industrial sector, as well as all the suppliers that these car makers, for instance, need in order to produce down there. And then the last big driver is consumer sentiment, which drives e-commerce. And that's actually been really strong and resilient. In fact, it's improved in the last few months. So we are hopefully not facing any recession anytime soon. And if consumer sentiment remains strong, that will support all of the above. That's kind of our take on it. Mostly Sunbelt markets and mid-size facilities that we're focused on.
Given the conditions in the capital markets that you've outlined, do you expect the securing financing to still be challenging even when you've got a good deal, a good story to tell? The lenders, will things loosen up a little bit more when you've got those good stories to tell?
The biggest challenge of financing today is frankly the cost of it. The availability has improved as banks have dealt with some of their historical book in terms of distressed loans. So you can get financing, and if you can't get it from a bank, there are now many non-bank sources, essentially credit funds out there. But they're opportunistic, and the cost of that financing is still quite high. So in recent investments, we've actually opted to finance them all equity because paying 7 or 8% for a loan these days seems prohibitive and in some cases non-accretive to the returns that we're targeting.
GTIS also has a significant footprint in multifamily, upward of 50,000 units, I believe. That's, if I've got that right. And I'd like to hear more about how multifamily in the US fits into GTIS's overall strategy. For example, what are your geographic sweet spots in that sector? Is it comparable to industrial? Is there anything that's a little bit different? If we could talk about geography for starters.
Yeah, sure. So the biggest part of our business in the 50,000 units actually refers to our single family platform. We're quite active in master plan development. So these are homes. In multifamily, we've done about 10,000 units. So it's not huge compared to some of our competitors. We're larger on the single family front, but they in many ways intertwine, and the distinction between those asset classes sometimes is kind of artificial. People separate the single family home business from the rental business, but there are many overlapping elements, not least what is now known as build to rent, which is homes that are built specifically to rent out rather than to sell. And we're quite active in that. But as far as the multifamily business, the drivers are pretty similar, and consumer strength being one of them. Employment strength and growth of income is important. As we all know, there is a big affordability challenge in both for sale and rental housing. And rental wins that game because at this point, it's about $1,200 more expensive to own than to rent nationally. So this is a broad statistic. Obviously, it varies by market. But when the for sale market is out of whack due to high interest rates, the rental market benefits. And we see opportunities for growth in that area going forward. Geographically, it is pretty similar, actually. It's again the markets that have job and population growth. So big Sunbelt markets like Texas, the Carolinas, Florida, Georgia. But interestingly, I would also put New York City in that group, which has recovered pretty much to pre-pandemic levels and is perennially short of supply. So the reasons why New York does so well are a little bit different. It's really connected to the lack of supply more than anything. But given reasonable job growth in New York, return to office mandates and so forth, we actually think New York is an interesting place to look at, given the shortage of available units. In the Sun Belt, it's driven more by the demographics. The movement towards the Sun Belt still continues, the demographic in migration. It's not as strong as it was during the pandemic when everyone wanted to move to Florida. It's back to essentially pre-pandemic flows in terms of population. So that will continue for a while. But it's pretty easy to come up with new supply. In places like Texas, you can build. And you need to watch that supply-demand equation pretty carefully. At this point, there is quite a bit of supply in places like Phoenix and Austin, and we would probably not rush into those markets at this very moment. It's more interesting to look at places like New York or some of the tighter Sunbelt markets, be it Raleigh, for instance, smaller market, not a ton of supply that will be active in the next year or so.
And in the build to rent category, which of course has attracted a lot of institutional interest over the last few years, how active do you expect that to be in the next year or so, 12 to 18 months compared to 24? Will it be status quo? Is it possible that there will be a significant change in the dynamics there in the BTR sector?
Yeah, it's been a very dynamic sector, and it's driven by what we call the frozen for sale market. Essentially, if you refinanced your house a few years ago with a 3% mortgage, you ain't selling it today, right? Because you would have to buy a smaller, more expensive house with a 7% mortgage. So a lot of owners are just stuck in place. And that means very little inventory in the for sale housing market. In fact, we have less inventory available today than at any point going back all the way to the early 1980s when this statistics began to be tracked. And we're twice the size as a country. So clearly something is not quite right with the for sale market. Obviously, you can always find an existing home to buy, but compared to history and how many homes are typically on the market, we're in a really strange position of having no inventory and very little choice for people who want to live in a single family house in the suburbs. So what are their options? Well, one of the most attractive ones is built to rent. It offers the lifestyle choice that's very similar to buying a house. You can live in a community that has the amenities of a suburban master plan. It's located in a school district that's probably better funded than the inner city where you would be renting an apartment. And it gives you space. And for families, especially millennials who are just starting now with almost a 10-year delay to have larger families, they need more space. Something like 3/4 of New York's housing supply is 2-bedroom or less. Well, try to have 2 or 3 kids and work from home in an apartment in New York like that, right? It's difficult. So families are essentially compelled to seek alternatives in the suburb. And if they can't quite afford to buy or don't want to buy because mortgage rates are high, maybe they have student debt, the other most attractive option is to rent. With the advent of the built to rent sector and the offering really growing, in terms of quality and quantity, that's a very easy choice to make. It's a great value proposition for someone who wants to live in the suburbs, but is not ready or cannot afford to buy. We were early pioneers in the single family rental business, so to say, showing up at auctions back in 2011-12 when we bought about 5,000 units out of foreclosure or REO, and we built a rental management company to manage that portfolio. We eventually sold that a few years ago to larger groups that came in to aggregate these portfolios into massive, in some cases, publicly traded REITs, and they manage them today institutionally. From that moment, we really refocused our effort towards building these built to rent, purposely built rental communities. And the markets are essentially similar to all of the ones I was describing before, whether it's in Phoenix or Dallas or Florida. That's where we see opportunities for built to rent. Now, with the demand so strong, developers responded to that a few years ago and started building thousands of units. Really tremendous increase and growth in the sector, which is now taking a little bit of time to digest. In places particularly like Phoenix or Austin, there is quite a bit of BTR supply. It's absorbing relatively well, but managers have to offer some concessions to fill it up because there are literally thousands of units available. We see that stabilizing as the new starts have now dropped following the banking crisis. There just isn't a lot of financing available for new development. So starts are off by 50%, which means 2 years later, there will not be enough product. And we're looking very selectively at developing new communities, but mostly at this point, looking to acquire existing ones at or below replacement cost. That's the most interesting trade today. If we can get our hands on a community that was recently constructed, perhaps has some liquidity issues because they need to repay their construction loan, something like that. If we can come in and acquire at the cost of building it, essentially, that is a very interesting trade for us because we do believe that fundamentals will be improving significantly in a year or two from now.
You really make a very strong case for why the commercial sector needs to keep a very close eye on the BTR and single family sectors because as the saying goes, retail follows rooftops, but also it influences every other of the on the commercial side, whether it's office or industrial or anything else. And you're involved with master planned communities, so certainly the mixed use aspect of it is important. So so these are all going to be trends to watch very carefully in the next few years. Peter, I'd like to turn now to your own professional journey. For example, when did you start getting interested in real estate finance and an investment career?
I was actually very interested in architecture and the history of art and architecture back in college, and I minored in that. So it actually, for me, came from the real asset side, if you will. But considering career options and maybe a little bit of looking at what my peers were doing, finance seemed to be the place to get a good start out of college and then out of business school. So looking for the combination of the two, I ended up working in real estate finance, which gives me just enough exposure to the real estate side of things where I can indulge, thinking about where we should invest and what types of assets and looking at places, but not being an architect, which is a great and noble profession. But at the time, and perhaps even today, really just looking at the financial rewards, it seemed like a lot of work to get through to the pinnacle of that profession, whereas finance in some ways was an easier, more direct choice at the time. And once you start your career in a certain way, it kind of informs the path. So from there, I worked at an investment bank, the infamous Lehman Brothers, a few years before the collapse, and that was an interesting few years. from there, I knew that I wanted to work at a smaller company, and so I joined GTIS 19 years ago when we were just 5 people at the time, and it's been a fun ride ever since.
You mentioned that you initially had an interest in architecture and design. Do you find that having an eye for architecture and for design, does that uh, ever ever help you inform your perspectives on things as a real estate investor and finance professional?
I certainly hope so. There is no shortage of dilettantes out there who would like to think that they have an eye for architecture. So I would not want to embarrass myself to say anything that I really don't know enough about. But I did do a bit of studying back in college, just didn't end up going into architecture school, which seemed like a lot of work, and is still a very responsible profession with just a lot of um, work that goes into it. But I hope I, over time, gleaned enough about different designs and, frankly, their commercial applicability and returns that designs can generate, that hopefully informs how I view the industry today. Again, certainly don't fancy myself to be a professional in that field, but as a development oriented firm, we spend a lot of time thinking about the right designs, the right locations, and the right product for every specific market.
Well, now we come to one of my favorite parts of Investment Matters, which we like to call executives off the clock. We can't always work 24/7, although it sure seems like we try sometimes. So, when it's your turn to finally have a change of pace, could I just ask you, do you have any favorite ways to step away from the daily grind for a little bit and have some time to yourself?
Well, if I have the time, I really try to get out, meaning get out of the office, get out of New York, enjoy nature, enjoy travel. And so I try to take a couple of trips every year, have been to 50 countries plus
Mhm.
around the world on all continents, and there is still plenty to cover. I don't think I'll have enough lifetime to really see everything I want to see, but my biggest hobby, if you can call it that, is travel. And then I like gardening, nature, just to get out of the concrete jungle and plant something that I can watch grow. Has been an interest that I've taken up in recent years.
Yeah, absolutely get you out and about out in the outdoors and the fresh air. That's great. Well, as far as your worldwide itinerary is concerned, though, do you have any favorite, just an example or two of a favorite destination that really, stands out in memory?
Oh gosh, there are so many for different reasons, right? I love visiting Southern Europe, Italy, Spain, Greece for the history. That's the cradle of our civilization. And you can see things from 2000 years ago that still amaze today and how advanced that civilization was and how much wisdom they actually had that seems to be kind of lost over time. But spending a lot of time there during the summer, and then in the winter, warm places on the beach are always fun. So places in the Caribbean that I'm still trying to discover all the different little islands. I don't know that I have a real strong favorite. There are different places, but I've traveled in Mexico in kind of secondary locations, and there is really interesting things to see there. Again, both the history, some of it sad because of the colonial period, but some of it quite fascinating. So I would recommend of the beaten path places in Mexico or Central America more generally. There is a lot of stuff to see there.
Well, that's great, and it sounds like that you're not going to run out of places to discover anytime soon, Peter.
No, I really want to make a bigger trip in Asia. Sadly, it's become more difficult to travel there. I remember backpacking through China during college. I don't think people do that today, do they? At least I wouldn't feel like it's quite as open as it was 25 years ago, which is a little disappointing.
Well, Peter, thank you for sharing those insights into not only your travels, but of course into the real estate capital markets and investment picture right now, and giving us a window into GTIS's strategy for 2025 and what you're looking at. Appreciate the time. Really nice having you today on Investment Matters.
My pleasure, Paul. Thank you very much for having me.
That was my conversation with Peter Ciganik of GTIS Partners. Before you go, let me tell you about an exciting opportunity. The CPE Executive Council is a group of industry leaders to exchange ideas about trending real estate issues. Highlights of their discussions are posted on our website and featured in our newsletters. If you're interested in joining the council, please contact CPE's Editor-in-Chief, Jessica Fear, at jessica.fear@cpe-mhn.com. That's jessica.fiur@cpe-mhn.com. Please join me next time for another conversation with a leading commercial real estate investment executive. You can find archived episodes of Investment Matters and more CPE podcasts on Apple Podcasts and on our website, commercialsearch.com. Until next time, thanks for listening and be well.